We all remember the 2008 housing bubble and the market crash of '08, otherwise known as the Great Recession. And we remember that when it popped, how it completely devastated the housing market. It devastated the housing market so much that it has literally taken over a decade to recover. And now a lot of people believe that we're in a situation very similar to that of 2008. In 2020, existing home sales, which make up a majority of the market, totaled 5.64 million, which is up about 5.64% from 2019, and we're on pace to basically be right on the tail of that of 2006, where there was a total existing home sales of 6.48 million. And today, 1 in 5 renters are behind on their rent, and landlords are currently owed $57 billion in back rent, utilities, and fees. And obviously things aren't exactly like they were back in 2008, so that's not necessarily what I'm saying, but things in certain areas do look a little bit similar. Now, lending requirements are a lot tighter and a lot stricter today than they were back then, and that's one of people's biggest arguments when comparing right now to that of the '08 market crash. Back in the mid-2000s, borrowers were going and they were buying homes that they quite literally couldn't afford. You had postmen that were going out and buying $1 million houses with basically no money down, okay? So, definitely have a little bit tighter lending requirements today than we did back then, because the subprime mortgages that were given out back then was something like 21 or 22% of all of the mortgages. Financial firms were knowingly packaging all of the home loans and selling them to investors as securities, and basically when people started defaulting on their mortgage, in a nutshell, the entire financial system kind of fell apart because of the amount of subprime mortgages that there were and the people that couldn't afford them. And that ultimately became known as the subprime mortgage crisis, and Americans ultimately paid the price for that. And from 2006 to 2014, 9.3 million Americans went into foreclosure. And obviously we don't want anything like that to ever happen again. Now, there are going to be ups and there are going to be downs in any market, including the real estate market, just like the stock market, okay? But at the end of the day, although there are some similarities between now and back then, there are definitely some key differences also. So just make sure that you go ahead real quick and smash the like button for the YouTube algorithm. We're gonna go ahead and jump right into the video without further ado. So for starters, economists say that the current boom is far more stable than the last one, and basically we don't have a ton to be worried about, but there are some key components that we want to kind of look at. Most real estate analysts that go ahead and they look at the global pandemic that we just went through can all kind of get together and agree that in some ways it actually helped the housing market a ton. It really forced people to step back and take a look at the home that they lived in and really ask themselves why they lived where they lived, and whether or not at some point or another they want to go ahead and they want to move, they want to get into a new build, they want to go to the outskirts of town because maybe they're working from their laptop and maybe they're never going to go back to their office again. And there's multiple big companies that have said, hey, stay at home, work from home, and never come back. One of the big trends you're probably familiar with are all the people that are leaving California and New York City, and they're going places that are a whole heck of a lot more affordable. Now, places like California have a lot more problems than just the housing affordability index, such as taxes and the fact that you can't water your lawn, but we'll save that for another video. People are obviously migrating to places like Florida, Texas, Idaho, and Arizona, and they've been migrating for a long time. And to be honest with you, the pandemic only made the migration patterns even more apparent. When lockdowns began lifting last year, home sales literally skyrocketed like nothing we've ever seen before. Supply pretty much went to nothing. Demand went straight up. June sales surged nearly over 21% as opposed to the month before that, which would have been May of 2020. And that is the biggest monthly increase on record, going all the way back to 1968. And that milestone lasted only about a month when July literally broke another record, and that rose 25% 1 month later. And another big thing that we have to look at is a lot of the real estate analysts that are looking at the overall market are basically saying that there are definitely other key components that are going to keep the real estate market strong even after the pandemic kind of hype fades away. And one of the big key components is the fact that millennials, the largest living adult generation, are getting into their prime time buying years, and they're going out and they're buying homes in flocks. There are a ton of millennials out there that are saving money for a down payment, and they're going and they're getting into a brand new house. And with all of the amazing benefits of buying a brand new home, such as the amazingly low interest rates and the fact that potentially the new administration is going to be rolling out even more incentives to first-time homebuyers. Now, obviously, that's going to greatly help all of the millennials out there who are looking to buy a home, and it's going to definitely prevent them from having to put so much money down. But one of the big problems that I can see with that particular thing is the fact that our supply is already basically nothing. So, if we're just going to keep creating more demand, but we haven't figured out a way to get people to sell their actual house that they own, and we don't know how to get new home builders to build any faster, then the reality of the situation is home prices are going to continue to just go up. And what I'm referencing, of course, is the new administration's $15,000 tax credit for first-time home buyers to help them not have to put so much money down, and that will especially, obviously, basically target millennials. So it's obviously clear that we have way more of a foundation than we did back in 2008, and the amount of subprime mortgages that we're giving right now are nothing like we saw back in 2008. But there are a lot of other variables that we have to kind of consider when figuring out, whether or not we're headed towards a market crash, or at some point if we're just going to plateau, or if we're literally just going to continue to go up and up and up forever. So right off the bat, one of the key differences is back in 2008, one of the reasons that the housing boom kind of took off was the easy access to money, right? The easy access to go ahead and borrow and get a home loan. But now, one of the biggest things is because of the low interest rate. So everybody's refinancing and everybody's taking advantage of the 30-year fixed interest rate that hit all-time record lows of the mid 2%. The thing of it is right now, though, is Americans have more home equity than ever before. So one of the big things that I've seen a lot of other people talk about is the fact that there's a ton of people that are delinquent on their mortgage right now. Somewhere between 2 and 3 million that are in forbearance. But the reality of it is, one of the options that people could probably do is just sell their house due to the demand and the amount of equity that they have in their house, and now they're not facing foreclosure anymore, and instead they're putting cash in their pocket and they're walking away. But at the same time, a lot of the lenders are just continuing to tighten standards over and over and over again for borrowers, including Fannie Mae and Freddie Mac, and even including on investment properties. So they're certainly not making it easy for a buyer to go out and actually get a home loan, to get a mortgage on a property. So it's a very interesting time that we're living in right now, to say the very least. And homeowners overall in 2020 gained a combined $1.5 trillion of equity, which is 100% mind-boggling. And to add to that, a lot of people have actually saved money by refinancing out of an old higher interest rate into a lower interest rate, and a lot of people are even renovating their homes or buying a second vacation home. And sellers aren't the only people. You have real estate brokers, home builders, and mortgage lenders who are also following the trend, and the S&P Home Builders Select Industry Index is up 96% over the past year, outpacing the S&P 500's 59% gain. But again, we have to look at the silver lining, which is it's incredibly hard to break into the buying market right now as a first-time home buyer, or really any buyer in general, due to the fact of the incredibly low supply. And U.S. house prices soared 10.8% in the fourth quarter from a year earlier on a seasonally adjusted basis, the biggest annual increase in data going back to 1992. And a little fun fact is that the median home purchase price actually soared a little bit above $300,000 last year for the first time ever. And nearly 1 in every 4 home buyers from April to June last year paid more than $500,000 for a purchase of their house. And And according to NAR, basically all of the cheap houses in the market have basically gone extinct. I mean, they're pretty much gone. Anything less than like 500,000, depending on the market you're in, maybe less than 350 to 400,000. You know, these cheaper price point homes are pretty much non-existent. Now, obviously, everybody's primary focus, I would imagine, is to prevent the housing market from bursting and to basically prevent, if we are in a bubble, from the bubble popping. And nobody wants to see what we saw back in the last recession, okay? So I think everybody is working hard to prevent that, but it definitely doesn't help when you have a Federal Reserve Chairman, Jerome Powell, literally keeping interest rates low, continuing to print money to stimulate the economy, which in turn causes more demand and less supply, and so on and so forth, obviously, which we talk a lot about on my channel. But again, I do think that we have a lot more of a stable foundation. But I'll tell you what, it is a little bit crazy when we look at all the statistics at play and we look at what is going on. And I myself am obviously a real estate investor and a real estate agent. And I'll tell you what, the market right now is incredibly fierce. And to get into the market, whether you're an investor or a buyer, or really just about anybody other than a seller, it is almost impossible. So at some point, the market is going to have to, at a very minimum, soften up a little bit. And I've made other videos on my channel talking about how we just need a little bit more supply and we need demand to cool off just a little bit. Now, we are starting to see interest rates go up just a little bit, and I think they just went up a bit past 3% as the 10-year Treasury did, and typically mortgage rates follow the 10-year Treasury on average, okay? So, you know, we're starting to see, I think, a little bit of movement in the housing market. And again, if you're in New York, if you're in California, if you're in any of the places where the migration patterns are people leaving and not coming to, then you might already be feeling this. I would love to hear from you if you're in one of those places where people are getting out of. Are you already feeling the housing market kind of soften up a little bit or not? Definitely drop in the comment section below. I would love to have a conversation with you down there. If you're still watching the video, by the way, gosh, I would greatly appreciate if you would do me a huge favor and take just a minute to just smash the like button for the YouTube algorithm. And also, I've got a couple of links in the description down below of how I actually continuously find amazing investment opportunities as a real estate investor. So definitely go check that out. I greatly appreciate it, and I'll look forward to seeing you in the next video.